One message that has emerged today again and again is the vital importance of cooperation in a world that sometimes appears to be falling apart at the seams, dividing into rival blocs that are prone to misunderstanding and mutual tensions, which is why we decided to conclude this year's European Banking Congress with a view from outside Europe. We are very honored that the President and CEO of the Federal Reserve Bank of San Francisco accepted our invitation to join us. She's had a distinguished 27-year career at the bank, which is the largest and most diverse Federal Reserve district in the United States, and she also serves as a member of the U.S. monetary policy setting body, the Federal Open Markets Committee. Mary Daly, we are so honored to have you with us. Please, the floor is yours.
Thank you. So thank you very much for that warm welcome, especially towards the final hour of the Congress. So I do appreciate it. It's delightful to be here. I've really enjoyed the discussions I've heard so far, and what a distinguished set of guests that you've had up here speaking. So I'm going to give some initial remarks and then look forward to a robust conversation about all that it is before us. So I want to start, because the topic is about uncertainty and chaos and flux, and I want to start by just talking about how I face those things as I think about monetary policy. And I'm going to go back to 2004, when I first read a speech about making monetary policy in a dynamic world. It was written by then Governor of the Federal Reserve, Ben Bernanke. And Bernanke noted that when central banks know about where the economy is headed or face imminent risks to their goals, they should adjust policy decisively and aggressively, what he termed the cold turkey approach. He then noted, and this is the important part, that in almost every other instance, more caution is warranted. When central banks are unsure about how the economy will evolve, when they are unsure of the impact their policies will have, or when they are uncertain about the fundamental benchmarks in the economy and how they are changing, the optimal strategy is to look before leaping, to take the gradualist approach to policy. Now, I reference this speech and its lessons to remind us that the economy is always and has always been dynamic. Change is inevitable, and uncertainty is a fact of life. But monetary policy can adjust, going quickly when conditions demand and more slowly when the road is less clear. Our tools, our strategies, and our actions can always meet the moment. The choice, of course, is ours. Do we do it? Now, before I go much further, I need to remind everyone in the room that my remarks are my own today, and they do not necessarily reflect those of my colleagues or anyone else with the Federal Reserve System. So what is it we face today? What are we looking at? Well, as many of this conference have noted, we are in a period where the risk seems high and the water's murky. After the long fight through COVID, economies around the globe are facing a range of crises and complexities. Wars in Eastern Europe and the Middle East, the rethinking of economic relations and global production chains, disruptions and dislocations from climate, and the potential impacts, good and bad, of artificial intelligence and generative AI. Central banks also face these challenges, as well as a policy landscape that has shifted significantly in the past 4 years. If you recall, and the panel mentioned this a little bit, if you recall that prior to COVID, central banks around the globe were focused on weaker trend growth, low interest rates, below target inflation, and policy tools constrained by the zero lower bound. Policymakers were focused on providing sufficient monetary policy accommodation and keeping inflation expectations from falling. Post-COVID, the landscape has reversed. Inflation in most countries is now too high rather than too low. Global interest rates are elevated, And central banks are wondering whether they'll need to tighten policy even further to fully control inflation. Policy discussions and debates are centered on what constitutes sufficiently restrictive and how long to remain in that stance. This is quite a lot of change in a policy landscape in a very short period. So it is somewhat surprising, I'm guessing, that I chose Ben Bernanke's remarks from 2004. You might say, how can they still be relevant? But my argument is that they remain durable. Because ultimately, the speech talked about monetary policy as being flexible, adjusting to the conditions as the conditions change. And I think that is the most important lesson today, that we have approaches, we have strategies that can work through a variety of situations, and the job is to use the appropriate one. When we know, for instance, where we are going, and it's important to get there quickly, well, then moving aggressively makes sense, and cold turkey, as he called it, is the appropriate action. We've seen this many times in history, many of which I think you'll remember. It was the strategy during the global financial crisis when central banks quickly lowered the policy rates and did multiple rounds of quantitative easing and forward guidance, all in an attempt to stave off the worst outcomes. If we go back further into the United States, Federal Reserve Chair Paul Volcker took rapid and aggressive action during the late 1970s and 1980s to fight double-digit inflation and a vicious wage price spiral, so took the opposite action. And very, very recently, over the past 4 years, policymakers across the globe have acted decisively in response to the pandemic, bringing all the tools we have to bear to offset impending damage to the economy. And then, when inflation followed and proved to be persistent, central banks have raised rates rapidly to bring the economy back into balance and restore price stability. Each of these actions that I've just gone over were bold. Central banks were clear on what the moment demanded, and they acted forcefully, judging that the risks of aggressive measures were smaller than the cost of any potential policy errors. But most times that we face are not so clear, and a different type of boldness is required, the boldness to wait. When uncertainty is high and the risks to our objectives are more balanced, we need to practice gradualism, to resist the desire to be certain when we don't know, to react to not knowing with curiosity, and to adhere to the idea that patience, measured adjustments, and continual reassessment make for better outcomes. Practicing gradualism means having the confidence, the wherewithal, to say that we don't yet know, and keeping an open mind about what the world is bringing. There are many times when gradualism is the best strategy, and there are countless examples of central banks using this more cautious approach. I would submit that the reason it is so frequently used is because it applies to so many different situations. And if you go back all the way to 1967 when this idea of uncertainty by Brainerd was introduced, you can just watch the research literature subsequently talking about all the types of uncertainty to which this strategy of gradualism would apply. Uncertainty about the economic forecast, just how will the economy evolve? Uncertainty about the monetary policy transmission mechanism, the lags, how weak or strong it is, whether there are wedges or disruptions that interrupt it. And uncertainty about economic fundamentals, like the natural rate of unemployment or the natural rate of interest. In this moment we face today, we are grappling with all of these situations, all of this uncertainty. And I'll for a moment say at the Federal Reserve, when I take those uncertainties down to the level of the monetary policy making body I work for, we are not certain about whether inflation is on track to return to 2%. We are unsure about the length of lags and whether they are behind us or still to be fully realized. And we are uncertain about whether the dynamics we observe today are cyclical remnants of the post-pandemic recovery, or indicators of structural shifts and a new normal for the national and global economy. And the truth is that none of those things are actually knowable right now. And the perils of deciding too quickly, racing to know when we are not sure, are real. Declaring certainty without knowing is not just a missed forecast. It's a policy mistake. And it has the potential to leave a lasting imprint on the economy and negatively affect those we serve. So here is the main message of my remarks, the thing I'd like you to leave today understanding that I said. Uncertainty is a fact of life, but it does not leave us rudderless. We are not adrift. We have the tools and the experience to navigate whatever comes our way. Our challenge will be what it has always been, to respond rapidly when the situation requires, and to resist the pressure to act quickly when patience is needed. To have the will to make these choices, that is the policymaker's real job. And we need to be collectively up to the task. Thank you very much.
We need to get you a microphone. Do we have a hand microphone that Mary could use now? Sorry? Haben wir ein Handmikro? Dankeschön. So, there we go.
I've been told I project my voice, but perhaps not
Beautiful.
that much.
No, that's lovely. And
Okay.
Mary,
Where
what
would
a
you like me to sit?
wonderful, you can be right there.
Okay.
What a wonderful philosophical ending to our day. Because, you know, we began with this keynote by Christine Lagarde, who quoted Emerson and Kant, and you quoted Bernanke, but you turned it into...
Not quite a philosopher, but, you know.
You turned it into really a philosophical overview that could go far beyond monetary policy. The idea of reacting to uncertainty with curiosity is wonderful, because so often we react to uncertainty with fear, with hectic actionism, just simply do something because it's better than doing nothing.
It makes us feel in control. But I would argue, and I think I tried to argue, that actually hectic franticism, what did you call it? I love that.
Actionism.
Actionism is actually not control at all, because you don't have the time to collect the information. So being curious is a posture that actually leads to better outcomes, but also leads to a more settled approach to things, which I think is beneficial.
I think Mary is telling us essentially that that Kantian mind shift that Christine Lagarde was talking about could go in the direction of being more showing more equanimity in the face of unknowables, or at least temporary unknowables, from what you said.
No, exactly. And I did major in philosophy as an undergrad, but I never thought that I would be in a conversation about monetary policy where we talked about it. But indeed,
You're in Germany.
I'm in Germany, exactly. The great philosophers are always part of the discussion. So
let me bring us back to the concrete now, and to monetary policy per se. Normalization featured in the title of our first panel today with the CEOs of the host banks. And I'd like to get your opinion on whether, in fact, higher interest rates are the new normal, because it's not that long ago that we were talking as if essentially zero inflation was going to be there for eternity.
Absolutely. So coming out of the global financial crisis, two things happened. While we were fighting the global financial crisis, the structural trends on the neutral rate of interest were pushing it down, and that was leaving central banks with less policy space, and it was a concern that we would get inflation back up to our targets wherever you sat. And I remember in the United States, we were really worrying that 1.8, which is what we carried for a decade, wasn't just a precursor to not hitting 2, but that it would actually be a precursor to the next crisis. It would fall further, and then we're out of policy space, and we're just in this wave of never being able to get us back up. And that we've seen what happened in Japan, that deflation is arguably as bad of a problem as inflation. We just have less tools to throw at it. So absolutely. Then the pandemic comes, interest rates rise to fight high inflation, and now while these things were happening, it is often this way in my career I've seen, while we're doing important crisis level work or risk level work, structural things in the economy are happening that we need to take account of. And so now there's a question about whether our star has actually risen. Will it be higher? If in our own calculations for the FOMC, if you look at the summary of economic projections, we have a real neutral rate of interest of 0.5, an inflation target of 2. That gives you a nominal neutral of 2.5. The question is, has that gone up? And so our settling place will be lower. I mean, the way I think about it is it's far too early to know, but the things that are in place could push it in that way. You could talk about the demand for investment versus the supply of savings. So there's enough work and research that suggests that the baby boom and the supply of savings, it's baby boom in the United States, but the aging of the population is sort of in train now, and so the supply of savings is being drained, not built up. The other thing that is happening is governments are spending more as a percent of GDP. They're running deficits and debt. That will be something that pressures it. We have AI coming on. It depends on if companies invest in those things, and of course there's the greening of the economy. And as Volker said, this is only inflationary and problematic if it doesn't create productivity, but there's some transition dynamics in the middle that could either persistently or temporarily boost our star. So I think we have to keep an open mind about that, but again, I caution myself about this. The estimates on our star, I just got a book of estimates, they're about 15 models, range from -2 to 11%. So we don't actually have a good handle on what those are, but we have lots of people thinking about it, and I think that's appropriate.
So one of the things that we do not yet fully know, and that was evidenced in some of what we heard today and also in the polls that we saw just now on when the Fed will start
I didn't
reducing.
vote
and you didn't
on the poll, just so
Very
you know.
good. Thank you for disclosing that. Is what the path of disinflation is going to look like,
Sure.
how painful it's going to be, how the lags look, as you mentioned, all of those not fully knowable. What we do know is that coordination and communication can help to reduce the pain of disinflation. But coordination is a little bit touchy because central banks, of course, are independent. On the other hand, if we look at the results of the poll, clearly the audience was expecting that the Fed and the ECB will be closely aligned in their reduction paths. So what's your take? What is the space for central banks to coordinate? Are we in a new era where they're acting in highly coordinated fashion?
So I would separate this because in many ways, actions that we observe can be observationally equivalent. There can be explanations that are different. And so let me offer you a different take than coordination. I would say that central banks are highly collaborative and have grown more highly collaborative in my career. We go to conferences, we talk to each other, look at the group of people in this room. We're always engaging with each other, but it's not to say, what are you doing? Maybe we should do it. It's really to say, what are you facing and how are you approaching it? How do you imagine working through these things? So then when do central bank policies look similar and when do they look different? Well, they look similar when we've faced global shocks, the pandemic, the global financial crisis, the high inflation. Those are all economic developments or world developments that mean we have to all address them simultaneously. And so it's not surprising that our policies would look similar. But we're now to a point where I wouldn't be surprised to see more divergence in things, despite the poll, is because the conditions are changing. Most countries in the industrial world are still facing high inflation, but the US has a strong real side economy, and growth in Europe, the UK, other places has been flattening or slowing. That may mean something different. I can't speak for my ECB colleagues or my Bank of England colleagues, and I will not, but I would say that what's appropriate is that central banks maintain their independence and ultimately work on the mandates that they've been given. And those mandates are for the sovereign or for the entity, the ECB. The Bank of England works for the UK. We work for the United States. And when we face global shocks, you'll see similar behavior. When we face specific shocks, you will see different behavior. And I think that is actually what is best practice. So I don't see it as a new era of coordination because I don't see this as coordination. I see it as smart people trying to do their best to face a crisis, and the monetary policy toolkits are quite similar.
And as you pointed out, the effects nonetheless may differ, and
Yes,
certainly
absolutely.
this body, we took polls last year as well, and many doubted that the US would manage a soft landing to the extent that it has proven possible so far.
Well, I think it's very challenging if you look in periods of history to find a lot of evidence that adjustments from high inflation to price stability are easy. I mean, we have periods where you can move off of a tightening cycle and come down, but it's really challenging to find moments where you could say, okay, we've done it, so we'll just do it like that. And what's prominent in the minds of many who study the US or live there is the Volcker disinflation, because it's the last period of time when we've really had high inflation that was meaningful. So you put those two things together, and of course, if you looked at the market participants or even models, et cetera, surveys, consumer surveys, a year ago, in March of this year even, you would see that there was a recession prediction that was pretty high.
Yeah.
That has not materialized because we've had consistent, strong consumer spending based on a couple of things: excess savings that people had built up in the pandemic, but also just the sheer strength of the labor market.
Yeah.
And those things support the real side growth that we've been seeing. Now, we are trying to accomplish something quite simple, which is what all of my colleagues in other central banks are trying to accomplish: bring inflation back to target as gently as possible. So far in the United States, that's been fairly gentle, but I wouldn't want to declare victory on either our inflation battle or get overly optimistic about what kind of disruptions in the economy there will be. I feel very thankful that we have had very limited disruptions thus far, but we have to continue our hard work and make sure that we get there as softly as possible, as gently as possible. I would say, if I may, that when I said smart people, I was referring to my colleagues at the ECB and others. but I think earnest is the better word. Earnestly trying to do their work.
Thank you. One last question, if I may, on communication, because I found very intriguing, as I said, your notion that central banks need to be thoughtful and gradual and sensitive to nuance in their policy making. That doesn't always add up to something that's easy to communicate. So how does that play out when you are shaping messages for the public, which of course have a major impact?
So it's really interesting, and I was trying to decide whether I wanted to say this, but I will say it. It is easier to message and communicate with the public than with the market, right? Because markets are having their own forecast and they're having their own ways of thinking about the economy, and that's fine. But when I'm out, and one of the roles of Reserve Bank presidents in the United States is we spend a tremendous amount of time in our districts talking to business leaders, global business leaders, local business leaders, communities, worker groups. What we're hearing right now, what I'm hearing, is that inflation's still a worrisome idea. People are worried we're going to stop short and then have to go harder. Mm-hmm. And that is, so communicating that we have strong resolve, we're vigilantly looking at the information, and that we can now we have policy in a good place, and we can take our time to do it right, is actually a fairly straightforward message. But when you're talking about the sort of cadence of the media and markets, they're looking about, what are you going to do next week? What are you going to do at the next meeting? And I would really offer that at this point, strategy is more important than tactics. A tactic is what will we do in our meeting in December. A tactic is what will we do in January. The strategy is bring price stability to restore price stability as gently as we can, recognizing that people want two things. And I think this is true everywhere, but in the United States we have a dual mandate. They want to not think about inflation, and they want to have a job if they would like one. Those two things have to be our constant focus, and if we communicate it like that, I think people understand what we heard in the previous panel and from previous speakers, is that we will work hard to communicate how we'll get about doing that, but our resolve is always the same: bring inflation back down as gently as we can.
Thank you. And I think certainly what I hear from that is that perhaps we in the media and certainly the markets, we're always looking for binaries. It's up or down, it's win or lose, it's good or bad, and that's what we try to interpret messaging.
Absolutely, and it leads to, a lot of the, what are you going to do? And it leads to what I think of as data point dependence, as opposed to data dependence. One of the first things I learned when I went to school and learned economics was that data is a plural word. It's not a single data report, it's not a single series, it's plural. And really, I think getting into this data point dependence is what causes volatility. So backing away and saying, we're going to collect all the information and work to achieve our goals, that is where we need to be. But nuance is not as easy to convey in times. And I did it this way the other day. I'll see if it works for all of you. In sports, everyone understands standing mid-court. They understand standing midfield. If you're a European footballer, you get it. You don't want to get out of position. You don't want to run. I'll take tennis. You don't want to run to the front and then have the ball go over your head, and you don't want to run to the back and have it land in front of you. So middle court, or center court, not going to the sides, is the appropriate stance. But when we get to policy making, being in this ready position has people asking us, what do you do next? What do you do next? And so I'm telling people I'm going to stand here in the ready position, prepared to accomplish our goals. If the tightening cycle is complete because inflation comes down, that is terrific. But if it doesn't, we are prepared to do what it is necessary to ensure that that happens. Everyone's depending on it.
To revert to the metaphor used by Mr. Nagel, we are prepared to fire up the oven once again and put the half-baked cookies back in there.
And even better would be that we don't take them out in the first place, and we are patient. I have had this situation. I'm not the chef in my house. I'm not even close. So if you come to my house, do not ask for me to cook. But what I tend to do is say, oh, it must be done, and then I take it off, and then it's either burned to a crisp because I turned the fire too on, or it's undercooked because I took it away. That is not how I work on monetary policy.
We will remember. We will remember that analogy. And this has been the year of fascinating metaphors for monetary policy, many of them food-related, which is a novelty. So, Mary Daly, thank you so much for being with us.
Thank you so much.
It has been fascinating to listen to you.
I appreciate
Again,
that.
Warm round of applause. And ladies and gentlemen, that just about wraps up this year's European Banking Congress.